how does somebody then value, if you're looking for an exit, which presumably the implication is that that is what you're doing and that you're, pitching to investors that that's an exit, that's a possible exit for them as well.
Yeah.
How does somebody value the company if it is completely tied up in the value of the real estate as well? If they aren't separated, how do you get that unicorn type, 100x of NOI or whatever it is?
We think the most likely way to get that realization is through a listing event, right? So if you think about the natural path of tech-enabled stocks is that they eventually list, and that's when they get their biggest multiple, right? So they raise early rounds, and then once they've hit, think of Uber or think of Airbnb, then they list and they've manifest the value, and there's more people who can participate and believe in that value chain, right? Because Cushman & Wakefield, which is a real estate appraisal, their real estate appraisal business is just valuing the real estate. They don't care about that. It just sits on the books from an accounting perspective. How do you get that realized? Well, of course, you could bifurcate it and sell it off and get a valuation, right? You could come out with your own arm's length evaluation, but that, how do you really know what that's worth, right? Because unfortunately, in the tech business, it's usually only the worth is really measured by supply and demand, right? And how do you best measure supply and demand is make sure that it has a wide audience. And so we think the listing event would probably be the one that catalyst and allow the fintech value to be extracted or to be realized.